Hi, welcome to another episode of Funds Ki Baat. Today we have a very special guest. I think all of us on social media know him as like somebody who has been teaching us a lot about investing through his life experiences. We have Mr. Kalpen Parekh.
Hi.
Kalpen, by education, is a chemical engineer, but I think his entire career he has made in the mutual fund industry, which is close to 25 years of experience in the AMC space. And I think that is almost coincides with the age of the formalization of the entire industry. So there's a lot of experience sitting with us here. I see him as a very prominent educator in various ways, and I'm very excited for this conversation. So without any further ado, want to welcome Mr. Kalpen. Hi, Kalpen. Welcome to the show.
Hi, thank you, Abhishek.
How are you doing today?
Very good. Looking forward to the conversation.
Great. So, Kalpen, I introduced you. There's a joke in Three Idiots, right? You first did engineering, then did MBA, and then worked in finance. I was thinking I'll ask you. So, you transitioned from chemical engineering into core finance industry. How has that journey been?
So, if I had seen the movie Three Idiots during my engineering days, maybe I would have not done engineering because the movie taught that simple lesson that do what you're good at and do what you feel like doing. But in those days, we were used to doing what our parents would tell us. And 90s, the first 5 years of 90s were very similar in terms of the boom in chemical industry, like what we are seeing in the last few years. It's actually a full circle. The chemical industry was booming in 1990s. My dad was in the shipping business. He was a professional in a shipping company. And he would constantly tell me that our ships, sub containers full ja rahe, and most of them are from chemical companies. So you should become a chemical engineer. So that was the only fundamental reason to, go and take admission for chemical engineering. And I was an engineer for around a year after I passed out. But I realized that it was not really exciting me because 95 to 96, when I worked in few companies, I kept changing my jobs very often. So while I tell everyone invest for the long term, but in those days I did everything wrong. Within a year, I must have changed many organizations because my job used to be working with machines. And I remember one of my first company was 2 hours away from home. So I had to wake up at 3:30 to, reach the factory and then spend the entire night or day, depending on my shift, only with terminals and buttons and pipelines and boilers. Dur tak, there were no human beings, and sometimes it was a night shift. So I felt that, this is not really fun, and I'm not even applying most of the learnings of engineering. And in that phase, obviously that was the first, starting point for many people doing graduation in engineering in India and then, going to US. So almost 95% of my batchmates have either gone into industry or gone abroad and done their MS. But because I was not very excited, I needed an exit route. And somewhere someone told me that the best way to get out is to study again. And, the easier option is instead of doing MS, go for an MBA.
Yeah.
So I keep saying this again and again that a lot of my career journey or life journey is an outcome of randomness and not intelligent planning. As one would assume, most people would assume that you reach senior levels because of very thoughtful planning. So it's only randomness. I wanted to, move out of that work that I was doing. So went for my MBA. And I got selected in NMIMS, and that's how my journey shifted gears from being an engineer for a brief stint of 1 year into the world of finance.
Fascinating. You mentioned about a lot of randomness, right? I think randomness and chaos is a part of like evolution in life,
Absolutely.
right? And especially a lot of things which we're seeing now, it is also like not so planned. Like say 2-3 years back, or maybe say even the second wave of COVID, which was April 21, the sentiments, the beliefs were very different from what we are feeling right now. And probably that brings me to the next question, which is on the thought of, say, recency or recency bias, which I think is one of the most important. Like Mr. Munger has so many biases that he talks of, but I think I want to talk to you about recency bias because I think this is something that you have very strong views on. So how does recency bias plays in the mind of investors and how should one control it? If you could just talk about that.
Yeah, so I think as human beings, we are deeply influenced by many biases. Recency is one of them. And Investing is not secluded away from our day-to-day life. In investing also, we mostly behave the way we would behave in terms of most life decisions. I read a very interesting book sometime in 2013 or 14 by Rolf Doveli, and the name of the book is The Art of Thinking Clearly. It explains in very simple terms around 50 or 60 biases that make us take poor decisions in life, and almost similar poor decisions in investing. And for recency bias, he gives an example that when I think in 2001 or 2003, when the twin towers were attacked,
Yes.
and two planes flew into them, almost for the next 1 year, people stopped flying by flights because they felt that flying is risky and started taking more of road journeys. Whereas the base rates or data points around the history of travel shows that there are more road accidents than flight accidents. But the recent event, and especially if they are extreme recent events, they color our minds, and we presume that the same will continue for the near future. If in the last T20 match, if my team has won, my assumption would be that in the next match also, most likely the same team will win, or the same player will score similar runs. If Amitabh's last movie was a hit, the next movie has no connection with the last movie. It has no odds that because the last movie was a hit. So,
But the actor will get a better pay for the next movie.
Exactly. Yeah. So the pay will be, but for the viewer who is paying money to view the movie, there is no guarantee that if the last movie was a hit, the next one will also be.
True.
So what recency bias tells us is that we like to extrapolate near-term events. And we do the same in investing also. Whatever theme is doing very well right now, we assume that will continue in eternity. Whatever funds are doing very well in the last 2-3 years, we assume that the same will continue. However, the iron law of nature is cycles. And the iron law of investing also is mean reversion. So many times what is doing very well has very high odds of not doing well, depending on the characteristic of that asset class. So the odds actually are against you, but our recency bias makes us think that the odds are in favor. And that's where we end up sometimes taking wrong decisions.
So you have to put another way that if an investor is able to control their ability to get influenced by recency, they actually have an edge because majority still go by recency. So if I were to think of mutual funds, and I know this because I've seen this, people tend to select their mutual fund schemes looking at which schemes have done very well in the recent past. Say 1 year or 3 years, they put a filter, and these data points are very easy to tabulate. But investing is not a quantified art, right? Like I can quantify which funds have done the best in the last 1-3 years. How should, say if I'm an investor, I'm looking to invest in schemes, say if that is a wrong metric to look at, what are the right metrics to look at? How should I choose a fund?
So a lot of this is a function of available information, or what is easily available. We assume that what is easily available is the right way to do things. Not necessarily. Just because it's easily available doesn't mean it's the right way of doing things. So there's this story about a drunkard who was searching for a ring near a lamppost, and someone standing there said that I realized that I heard your wife screaming at you that you lost the ring closer to your home, which is like 0.5 kilometer away. Why are you searching for it here? And he said, because the light is here. In terms of investing decisions, also we look for data which is easily available. What data is easily available? Daily returns. Unfortunately, the beauty of mutual fund industry, which is transparency of daily prices, also becomes its enemy, because whatever is daily available gets tracked too frequently. Number one. Number two, our mind associates past returns with future returns, whereas in reality there is almost zero correlation, or very low correlation, or in fact at times negative correlation. What has done very well in the past, most often in the next round does not do very well, and vice versa. But because we are not trained to learn the right art of selecting your investments, whether stocks or funds or asset classes, and that art needs combination of data and judgment. It is not science alone, it is not art alone. Apart from that, it has randomness. So even if you may have a perfect combination of art and science, but the randomness may end up rendering your decision probably wrong. So the easiest thing to do is to look at returns, however flawed it is. So I don't think at any point in time most investors will change that pattern. True. And they will end up making poor decisions again and again, which will create opportunities for that rare 1% investors who have cracked the art of learning how to invest right. Which is why we always tell people that firstly, if you don't know how to choose funds right, take advantage of advisors. Learn from the experts first. Don't experiment yourself. If you want to do it yourself, first put in the hard work to learn what are the right questions to ask, what is the right analysis to do. And it doesn't happen overnight. It takes a lot of time. डॉक्टर बनने में अगर 8 से 9 साल लगते हैं अच्छा डॉक्टर बनने के लिए, हमारे धंधे में ऐसा लगता है कि इन्वेस्टर बनने में एक ही दिन सही है, राइट? वी अज्यूम दैट वी कैन लर्न इन्वेस्टिंग इन वन डे. देयर आर टाइम्स मुझे लगता है 25 साल के बाद भी आई एम ऑलवेज इन डाउट. And I have seen people with 25 days of experience are more confident.
More confident.
So the point I'm making is that one thing, and it took me almost 10 or 11 years to learn that the worst way to do selection of funds is to look behind, is to look at the last 1 year and 3 year return. And I'll give you 2-3 data points for that. When you look at 1 year and 3 year returns, there are only 2 data points. जिसने 365 days पहले डाला था और जिसने 365 into 3 roughly 1200 दिन, वो 2 ही डेटा पॉइंट के बेस पे आप डिसाइड करते हो कि ये फंड अच्छा है बुरा है, which is fundamentally flawed. Number 2, if let's say today a DSP FlexiCap fund has earned higher returns than most other funds in the last 1 year, who you investing today are not entitled to the return. The guy who invested exactly 365 days back is entitled to that return. He's the one who made that return. You are not going to make that return. In fact, we scream and shout saying past performance is not an indication of future. But I think people still assume that past performance only is an indicator of future. And lastly, whoever invested in, let's say, I'm giving deliberately the example of DSP FlexiCap fund, is because exactly 1 year back, this fund had negative 9% alpha to the benchmark. So, basis recency bias, it would have been a fund I should not feel comfortable about. But knowing that these are cycles, these things mean revert, knowing how if the fund manager is sticking to his ideology and letting mean reversion happen, the odds were higher for that fund to do better than some of the other funds even within DSP bucket which were doing better on that day. So I think I gave my own example that only 10 years later I realized that choosing funds on past performance actually ensures that you don't even achieve index fund returns. And yesterday I read a very beautiful quote. I think was it Taleb or Nick Murray. Nick Murray is a very a wise advisor in US. He said that we mostly invest in funds today the way we should have invested yesterday.
Okay.
What he's trying to say is that we choose funds today which look good today, but ideally they should have been our choice yesterday, 1 year back or 3 years back. And we hope that the funds we invest in today will be the best performers of tomorrow, but most likely the best performers of tomorrow are the worst performers of today. So I think it's not easy. In few minutes I can't probably articulate.
Yeah, I can understand what you are meaning, and probably that'll take a lot of reading and experience and self-experience for people to understand.
Self-experience is most important.
That's very interesting, Kalpen. Actually, that brings me to the thought of cycles in market, because we cannot talk of recency without talking cycles, right? So I'll quote your tweet, and I read this interesting data sets that even the returns of the index of Nifty has been fairly cyclical, and there has been periods of consolidation. And I'm very sure you would be very strongly in favor that you cannot predict which period will give you that high return, right? Yes. Say if I to put in numbers, early 2000 till 2008 was a period of great returns. 3 to 8 was a boom in Indian markets. And probably right now people compare this, are we in that phase, right? And then we had a period of lull till 13, 14. And again, we saw a cycle of some returns till 18. Then again a slow, and again we are doing well right now. So my question here is, but in all of this range, the index goes up. So actually, this is something that we were talking offline, and I'll quote for the viewers. He said, don't ask me what is my view on the market in the short term, because that is random. And if you ask me what is my view in the long run, the answer is always it will go up, because that is something he can say for certainty. Now, on that question, I will say that is staying invested for long run the only way to make index beating returns, or like what is your thought on this?
See, the best way to make superlative returns is to invest on the lowest point, get out at the highest point, and park safely somewhere, and again come back when you get the lowest point. But I have not found anyone yet who has successfully done that, because technically, when you look at long chart series or data point of Nifty or any asset class, you will see cycles. You will see it goes up sharply in a phase, then it consolidates or it falls. Let me talk about Nifty itself. We did this study a few years back, over 25 years of data. And 25 years is limited data for India, but for global market, it's slightly longer. And more than the price of Nifty, it is very important that you should know the value of the product, not the price of the product. So the value of Nifty is, let's say, noted through valuations, price to earning ratio. These are all hacks. They work 80% of times. They will not work 20% of times. So don't expect precision in anything that I say, but at large it works. The valuations of Nifty range. In bear markets, they hit a low of 10 times on earnings. In bull markets, they hit a high of 25, 27 times. So broadly, that is the valuation range. Normally at 10 times, something changes, that the cycle turns again. And at 25 times again, something goes wrong. And, it's like gravity starts pulling you down. And that's been the range. And over a long period of time, 30% of times markets trend lower. They earn negative returns. 30% of time markets rise. And roughly, 30% of times it goes nowhere. So 60% of times markets are, giving you negative experience. We like returns every day, but it goes nowhere or it goes down. And 40% of times it has gone up. Now, mathematically, it is giving you poor experience 60% of times, and 40% of times it's giving you good experience. Yet over a long period of time, Nifty has gone up 3,000%. Funds have gone up 7,000, 10,000, 12,000%. Why? Because those 40% of times when it goes up with a higher degree.
Yeah.
The quantum of that rise is higher. And someone has said very beautifully that all rallies are permanent and corrections are short-lived. Now this is true again for limited markets in the world. Now we are fortunate to be in a country like India where at large things have worked. We always take 3 steps ahead, 2 steps behind, but net we always take 1 step ahead.
1 step ahead.
So US is a market where long-term real rate of return from equity markets is around 6%, which means inflation के ऊपर 6% extra return बना है. Which means, if inflation globally was around 3-4%, you have earned 10% dollar return, which is amazing, which is not bad over 70-80 years. Likewise, in India, over 30-40 years, we have earned 6% real return on a 5-7% inflation. So,
can you repeat those numbers?
So, real rate of return is basically extra return over inflation, right? So, if inflation is 4% and you end up earning 10% return, you're actually earning 6% extra.
True.
So, that's the real rate of return. Now, if you take many markets in the world, for long periods of 10, 20, 30 years, the real rate of return has been 0. So it is not written or cast in stone that every market, especially in equity, has to make money. Hong Kong for 30 years now probably has 0 real rates of return because, the recent events in the last 2 years have given them a 30% drawdown.
Correct.
Japan took 40 years to come back to the old peak of, I think, 1980s and 90s. So we assume that because currently everything is rising, it will always be the order of the day.
True.
So coming back, the point I'm making is that in the long term, why should equity earn more is because equity has volatility. That it gives you some risk premium for the risk you're taking, number one. Number two, equity is nothing but ownership of businesses. And if businesses are able to create something productive of value to the world around them and charge prices because of that, charge positive prices every year because of that, then the value of that asset should keep going up. So that's a very fundamental conceptual definition of why equity should make money. But now there are many other factors. Many businesses are operating poorly. Many businesses operate with very low margin or very low ROE. So they are not destined to make money.
True.
So having these type of nuances is important. Coming back to that first formula, the range of valuations is 10 times to 25 times. So the average, long-term average is around 17-18 times. So if you invest at most points in time when markets are at fair value or below, the odds of earning superior returns in the next 3 to 5 years is higher.
Yeah.
If you invest when markets are in the higher band of valuations, which is 22, 23, 24, 25 type of PE ranges, generally the next 3 to 5 year returns are very close to bond returns or fixed income returns. You don't get that extra premium. In fact, most often in the next 1 year, you end up earning slightly
True.
negative returns also, or even zero returns. Either some bad news will come and markets will crash, or some event will happen and things will fall. This is at an aggregate Nifty level. So with that backdrop, the point I'm making is that one fact that we are establishing is that countries or markets which have meaningful 12 to 14% ROEs generally will deliver that type of long-term returns.
Yeah.
And which is why there is merit in being invested for the long term. Now, if you want to earn more than that, you have to time, but you have to time right. Most people want to time, but we end up timing wrong. So then what happens is you don't even earn that 12 to 14.
Yeah.
You learn. So
actually, I'll just add a thought there. I think a lot of these media headlines that we read are a representation of people's behavioral mistakes, because en masse we make behavioral mistake, we call it herd behavior, whatever, and we kind of paint it on the industry, that industry is not giving returns. The scheme, those who entered the scheme at the right point have made the money.
True.
And this is connecting back to something you had said something back. The data point and the information which is most easily available fools the most people, right? So if I were to think of investing, probably I'll say the kind of data points I can think of is price. Price is the easiest and the most tracked. Now the next valuable information is say financial performance, but I still think that has a slightly backward looking bias, because price is smart, right? Price knows those numbers.
Yeah.
And so that is still tracked, but maybe not by as many people who track prices.
Yeah.
The third variable is, which is not there in the numbers, not there reported in financial, but what lead to those financial are the operating metrics. True. And maybe even qualitative information.
True.
And that is where the edge resides.
Where the science and art both comes in.
That is the science and art.
By definition, edge is called an edge because it is limited. If everyone had it, it will stop being an edge. So most people, let's say if there are today 8-9 crore investors who invest in stocks and mutual funds together, they all think that, see, information is available to all 8-9 crore investors, at large. But different people will seek different information depending on their capacity to interpret and their liking for that information. Whatever may have worked for them in last round or whatever has worked for their neighbors or friends, everyone will choose the information of his or her own choice without asking the question whether that is the right information to look for.
True.
So while there are enough textbooks written about what are the right information, but who reads textbooks? हमने हमारे engineering की textbooks भी ठीक से पढ़ी नहीं थी. I remember I was cleaning up my bookshelf. I could see 3 books which were not even opened. तो finance की किताबें पढ़ना तो दूर की बात है. Very few people who
I did my CA and there was this chapter, standard costing there was an inter and final. So I did study in inter, and the final one was like half of the rest of the course. So I ended up skipping it because I knew there will be one question of 18 marks. And I knew I have to score 40 marks, right? It was half the effort, but 18% of the marks. And anyways, in 3 hours, I won't be able to answer all the questions, so I skipped it.
Yeah, so
and I did fine.
The data is available, information is available, how to learn is available, but where is the time, inclination, rigor? It's not easy again. And what is easy is to look at quick things which move fast. Prices move fast. They move real time. There's dopamine that hits you when you buy something and prices are moving up or down. So it forces you to act. So ultimately, as investors, we get trapped in activity illusion. We look, things which are moving fast make us act very fast. Whereas I think in the long term, it is stillness which creates compounding.
So Kalpen, I'll pause you there because I think we from here will try to simplify a bit because this is something I can completely understand what you're saying. But I'll say in all of this, it is seeming like a big task. But say for an investor who wants to make the most out of India's, or maybe why not? Why only India? We can discuss international funds later. But point is, I want to ask you 2 things. You are a big proponent of asset allocation, and I can say that is something very few people actually understand. Theoretically, people understand what is asset allocation, but it is very difficult to practice because there you have to let go of your greed. Because if certain things is doing well, you want to be all in on that. And that is a very common tendency, right? Sure. How should one say a 25 or a 35-year-old who now has seen at least one cycle of the market, knows that everything doesn't last forever, right? No, neither good times nor bad times. How should that person think of asset allocation? That is question number 1. And second is something personally I have seen that I think even in mutual fund space, a new product gets the fancy, and the latest one is multi-asset fund, where the USP is that okay, you get exposure to all the asset class via this fund. One is how should one do asset allocation? Two is multi-asset fund the right way to get asset allocation?
See, you've asked me a lifetime of questions and want me to answer in a few minutes. I'll try.
Sure.
See, how do you do asset allocation is secondary. How do you invest right is the first question. And whether whichever asset class you are investing in, whether it's real estate or gold or equities or bonds or global stocks, the first question to ask is that, is it a good asset class? Is it a good company? And am I paying the right price? And am I overpaying or paying a fair price? So the starting point is that own a good asset at the right price. That is the first principle of investing. So when I have my own crude framework that, I increase my equity exposure when valuations are fair or cheap. I reduce my exposure to equity by investing in hybrid funds or to some extent debt funds when valuations are very high. And there are those 20-30% of times when valuations become irrational. When the market gets drunk, I want to go and take a shower. I don't want to get drunk. So that comes through calibrating your overall risk. So that's the first rule. Likewise, in bonds, if you take Indian markets only, Indian bonds over the last 20 years, again, if you take 10-year GSEC, when interest rates crash, they go down till 5 or 6%. And when there is a crisis or a taper tantrum or a currency crisis or a very inflationary high regime, we go as high as 9 to 9.5%. So that's the broad band. 6 to 9 is the band. So you know that when you're closer to 6, the future returns you're going to earn in long-term bonds is going to be 6% carry minus mark-to-market loss, because eventually that 6 is going to mean revert to 7.5, 8.
Yeah.
If bond yields are at 9, you know that you're going to earn 9% carry plus capital gains, because it will mean revert. So that's a framework. Now, with that framework is the starting point to decide which asset class should I own more or less of. Now, some people will go all in basis their time horizon, their risk appetite, their conviction or lack of conviction on other asset class. So the formula for asset allocation should be overweight what is sensible in terms of future trend and pricing, and underweight what is not very sensible. Why do I never go all in or all out? Is because here I impose a second truth of life, is that most things in world are unknowable. Morgan Housel has said that maybe, we know 0.00001% of world history and our own experiences, and we see the world from that lens. So 99.999% things are unknown and unpredictable. So when I take a all-in bet somewhere, I'm assuming that I know the future. So it is a risk management that, okay, because I can't predict the future, I want to, diversify. And that ratio of diversification will be a combination of, valuations, where are you in the cycle, what is my personal risk appetite, what is my time horizon, combination of these things. If my time horizon is very long term, it is multi-decadal, then it's very obvious that equity is the best asset class. I should be, for that type of money, overweight equity. If my time horizon is only 1 or 3 years, irrespective of valuations or opportunity, if I need to pay something in the next 1 year, I will keep it in a safe instrument. So my personal preference is always, for long-term assets, be in equities. For medium-term time horizons, be in hybrid funds. For very short-term time horizons, be in bond funds. There is another nuance of taxation. If you directly buy bonds today, if you directly buy gold today, tax efficiency is very low. But when you blend these asset classes in a single fund today, tax efficiency goes up significantly. So these are other nuances to be kept in mind when you think of asset allocation. So that's how I would think about it. And lastly, I think of it like, from an engineering point of view, you always, the concept of asset allocation to me is basically increasing your surface area. When you increase your surface area, you are allowing more opportunities or probabilities to play out for you. When you are, batting in only one turf or one asset class, you're missing out on trends or opportunities in other asset classes. Look at global equities, for example. Just because, and then look at data. The first decade of this century, 2000 to 2010, is when the word BRICS got coined.
Yes.
And the thesis that got developed is all money is going to be created in emerging markets. We have seen that data being circulated widely everywhere. 2000 साल की history, India, China, kahan the aur kahan honge, and so on and so forth. In the next decade, the best returns were made by US. US markets made 11% dollar returns. China was 0 to negative. Fastest growth on earth and negative returns. India was somewhere in between. And it is only now that people are talking of global investing. We launched our first global fund in 2008. It is in
Wow.
2020 that,
I think that would be one of the earlier ones brought to market.
Yeah, we were the first
2008, yeah.
to start that. And but the real attention started only in 2019-20 when 10-year returns of US market started looking better than Indian market. So again, people chasing returns and recency bias. So what I'm saying is that what is investing, if you take it to its real truth, the first principles, when you're investing in equity, it is not a country which makes money. It is a company and its cash flows and the price that you pay, that makes money for you. So if 30% of global profits are coming from just 7 countries or companies of the world, obviously their stock prices will do very well. So we may fish in small ponds in different parts of the world, but big money is there. So as an investor, one has to be aware directly or by taking expertise of
Got
their
it.
advisors.
I think in this discussion, what I'm realizing is probably the role of valuation is something where we all flounder. Because at least the thing is, valuation ke bhi pehle you first have to be right on
First
the
have to be right.
first to be right on the
Yeah,
company
absolutely.
or the
Or asset
asset,
class.
right? It should have a long-term merit for you
Absolutely.
to invest. If something's history is 2 years and in those 2 years it has gone up 500%, probably you are in a bubble and you're entering that bubble late because
True.
that 500% doesn't belong to you. It belongs to the person
Someone
who
who
entered 2 years
invested.
back.
Yeah.
Right. So in this, I would say that I will ask you this question that I see you somebody who learns, who looks to learn from everyone. And by the way, that is something I really admire about you because I've seen that you have a very open mind about learning. So who in the investing thought, your investing process, who are the few people who have influenced your learnings in a good way? And second would be, I tend to believe in this, that investors should not only look at successful investors, but learn from all aspects. So second, if you would also talk of learning from people outside investing, maybe prominent names if you could take.
Okay.
Who has influenced your
Okay.
investing?
So, first you said why learning is important, and I'll answer that first because, learning has 5 alphabets. 80% of them is earn. So if you want to earn, you have to learn. There's no two way about it. And secondly, this is a domain which is not taught to us in schools, unfortunately.
Yeah.
Right? Cricket खेलना है तो हम 10 साल की practice करके खेल के सीख सकते हैं. Doctor बनना है तो again, you can study but this domain no one teaches you. And we still start with the belief that I know it all, which is why the role of learning is very important. I was very blessed, as you rightly said. I started my my career just when the industry was professionalizing and privatizing. And some of the best global funds had just started in India. So I was very fortunate to work with probably the most iconic companies of India. I'm very, very blessed. So I started my career with L&T Finance, and I worked with some of the best brains in the capital markets working in L&T's treasury in those days, in 95s and 98s, who understood currencies and interest rates and commodities. So very early, I got that experience. And the beauty is that when you work with great people around you, you learn and you earn also. Pagar bhi milta hai aur seekhne bhi milta hai. Within 2 years, I joined Prudential ICICI. Now, a lot of my, defining moments of principles of investing have come in those 9 years between 2000 to 2008. Because in 2000 to 2008, I saw the tech boom. I saw the 2000 to 2003 phase of Indian markets again going, Indian stocks, tech stocks. I remember when I started my career, Infosys was at 100 PE. Wipro was also at, I think, 100 PE. And by the time I ended my stint in Prudential around 2008-9, they had come down to 15 and 20 PE. So, which textbook would have taught you that great companies can have these type of cycles? And in fact, it is now known to all, right? Some of these companies for 15 years did not give returns. They became the most iconic companies of the world. They are the pride of India. But the investor who invested irrationally at, euphoric valuations did not make money. So I have seen in those first decade, the boom of tech, the 2000 to 2003 phase of 40-50% correction of Sensex and Nifty. In those days, we used to talk Sensex more than Nifty. 2003 to 7, we have seen the mother of all bull markets. Every time there is a 1 year good run in markets, we go back to that memory.
True.
Maybe that will never come again, who knows. but we are always misfed or misled to believe that we are in that bubble always. 2003 to 7 was a period when Nifty went up 7 times in 4 years. Small caps went up 15 times in 4 years. You learn wrong lessons. The wrong lessons we learned is small cap में हमेशा पैसा बनता है. And then 2007 peak till today, the small cap index has not even made 9% return. So the beauty is markets taught these cycles, and I worked with some of the best brains in the industry who are very celebrated people. Whether my ex-colleagues there, I've learned a lot from Naren, for example. I used to carry his bag and go for meetings along with him. So every conversation was a learning. And when I look back, each of those statements is something that I remember. I worked with many other managers. I worked with Manish for 3 years in Birla. Again, a guy who understands macro and cycles very well. So have been very fortunate here again in the whole concept of what is good. You said a very important point that more than cycles and valuation, first you have to ask is what you're buying a good business.
Yeah.
And my first early experiences with 2 colleagues here, Atul and Vineet, these are people who have the temperament to hold companies for very long periods of time. And that was, so people who think up from cycles point of view, think about getting in and getting out also.
Yeah.
And then there are some managers who think about saying that, okay, if I've liked a great business and a great management, how long can I stay? So I have few colleagues who have remained invested in stocks like IPCA and Supreme and Bajaj Finance for not 10 years. And at every stage, it looked like wanting to get out.
Yes.
So that temperament is something that I was lacking. And I learned with some of them here, where I remember my early meeting with Vineet and Atul, where they said that अगर कंपनी अच्छा ROC बनाता है और उसको reinvest कर सकता है for long periods of time, there is no better compounding than that. Then you forget timing and all that. Just stay for 20, 30, 40 years. A lot of wealth creation can happen. And this thesis also goes through questionable times when for 2-3 years these stocks don't do very well. But that temperament to suffer, the capacity to suffer temporary periods of. So these are my learnings.
But why do we call it capacity to suffer? I think we should actually change that term. I don't know what. I think capacity to suffer makes it such a negative. You're not suffering unless you have an emergency need, which is how we say that probably if you have an emergency corpus, if you are investing and you know that and more importantly, if you're earning, if you have an incoming inflow, why is there a capacity to suffer? Even
this is at a portfolio manager level. As an investor, you are not, because at a portfolio level,
portfolio managers have to suffer because you are measured.
You are measured every day.
Every day and every month on your NAV and with all others.
Yeah.
I'm saying for individual investor,
in fact,
even we don't even have a reason to suffer.
Absolutely.
We have to be invested in great companies.
So there, if you read, I think Ben Graham in one of the chapters has written that, and this is in concept of US, that if you are a consumer of hamburgers, would you like potato prices to rise or fall? And obviously everyone will say, I would like potato prices to fall. When it comes to investing in mutual funds or shares, ideally, would you like units to, the NAVs to rise or fall? If you are going to be an accumulator of units, a collector of units for the first 20 years of your career, where you're earning your monthly salary and you don't need this money, till very late, you don't want a bull market actually. You want a bear market ideally. Because you get lower NAVs, you acquire more units, and only when you need money, that 1 year you want blockbuster returns. That is how, if your mind gets wired or trained, I think people will start, looking at investing with a different lens. I remember again this is like a 15-year-old incident in my mind. With Naren, I was going to, meet someone, and we entered this reception where CNBC screen was on and the ticker was moving. And it was a down day. I think stocks were down 2 or 3%. So everything was red. And I just said that, yaar, aaj to kharab hai din. And he said, tumhare liye to acha hai, because tum to accumulator ho. So if you invest in this month or today, you're buying again at lower prices. So I think for people who are in accumulation stages, a flat market or a falling market is a boon. And for those who are in withdrawal state, for them, a rising market is important.
Got it. So here, I'll bring something that I'm not sure if you will comment on this, but say there's a lot of interest in small caps again, and you told me the long period return is 9%, which is lesser than the index and the large cap. Yeah. And probably against that long term 9% return of small cap index, the recency is like sub double ho raha hai, right?
Yeah.
So how, and we are ICICI Securities, we see what people are doing, right? So there's a lot of interest in small caps.
True.
In fact, even in mutual fund, the data is showing that the net
Lot of
inflows are increasing now in small caps. So how, if I go beyond asset allocation to say allocation at least within equity caps, so any thoughts on small versus mid and large at this stage?
So, see, we run a very successful small cap fund. And in fact, between 2014 to 17, which was again a bull market for small cap, we stopped taking inflows. We stopped taking money in 2017, February. Actually, 1 year early before the market tanked. We were wrong by 1 year. It went on for another 12 months and then it corrected for 4 years. So in our portfolio companies, as of now, we are not seeing that type of fraud and we are not even getting lots of money. So maybe money is going to a lot of other small cap funds, which in the last 1 year have done very well. Our portfolio companies have not really participated very extensively. So in that context, I am not very worried. My personal approach to small cap investing, having seen these long cycles of poor returns and very fast returns in short periods of time, my personal approach is I like to do SIPs in my small cap fund, because it takes care of the intermittent volatility. Even if my view goes wrong and the NAVs fall, I'm a beneficiary. And I do lump sum investing in small caps only in once in 5 years when there is some crisis. So when COVID happened, you got again the entire small cap bucket at 14, 15 multiples. 2013, 2008 to 13 was a long phase of economic consolidation, business cycle consolidation. Flows were just moving out. SIPs were cancelling to the extent of 70% of live SIPs that got cancelled.
Wow.
Very different trend than today. So everything was opposite. And 2013, profit-making small caps were all available at 11, 12 PE. Today they are all at 25, 30, 35, 40. So such periods is when you do lump sum. Otherwise, let SIPs take care. And the third way of investing in small cap, according to me, the way I do it is, most of my investments are in market cap agnostic funds. So they automatically will have the right exposure.
Technically, this is what we call multi-cap.
We call it flexi cap.
Flexi cap.
Yeah. And I want to just add one more point here, that one learning I have had is that it is not market caps which make money. Again, it is good companies bought at good prices will make money. There are bad large caps, there are bad small caps. There are good small caps, there are good large caps. So your portfolio should have basically good companies at good prices. I think if you focus on that, this lens of market cap is also in a way, confusing to our investors.
I mean, that's a good framework, that when should you do SIP way of investing versus lump sum. And I think we are now running close to the time slot we should do this. I would ask you some book recommendation, because I know you read a lot. Any book recommendation which you have read recently which you really...
So off late, the type of books I'm reading, I think very similar to yours, is on advertising, copywriting, how to write with simplicity and interestingness. One very interesting book I'm reading is Why Do Business People Talk Like Idiots? So I keep contrasting it to my way of writing.
Do you think so?
I do think so, because we use a lot of jargon, because we are used to those terminologies day in and day out, right? So I'll say multi-asset allocation very easily. But मेरे पूरे family में neither my dad, mom, wife, brother, sister, son will know what does it mean. But we'll talk in our sleep also.
True.
We'll talk, P, PB, so and so. Consumer doesn't care also and doesn't understand also. So there is huge need for the world of finance to not talk with a language of exclusivity, but with a language of simplicity. So some of these books are, my own journey of reflection and learning how not to write, how not to talk. It's not easy to unwind 25 years of wiring and start writing with simplicity. But when I read books by a lot of these copywriters, they ask the fundamental question that who is your consumer? What is important in his life?
Got it.
So damn good advice by George Louis is one book. I'm sure those who want to do investing may not connect, but that's my current reading.
We'll take 2 investing book names also.
So the one I mentioned, The Art of Thinking Clearly, for me is a very simple hack about knowing your biases. And ultimately, our biggest enemy is our own biases, and they are natural. So see, my thesis is go by base rates. Michael Mauboussin ने वो base rate का concept बताया, right? Now, if you look at base rates, there are 700 crore people on earth. Less than 1% have money. So the odds of being wealthy is an odd of minority, which means we have to behave also like that minority. If we behave like everyone else, the odds of being in that 1% is going to be very less. So, and why do we not behave like that 1% is because of our wiring and behavioral biases. So, The Art of Thinking Clearly, written by Rolf Dobelli, explains these biases in a very simple way. And for each bias, it gives a hack that how do you try to overcome this hack. So he says that recency effect you want to overcome, you write down 3 reasons why you want to invest and where can you go wrong. And the act of doing that will make you more aware. Seeking disconfirming evidence, not being blinded by authority bias. Another big error most people in investing make is they create authorities in their mind and blindly follow them. So that book is, I think, a very valuable book to me. I have, read it 10 years back, and I recommend that to everyone. And I think, like we all have learned, reading whatever Warren Buffett has written, all through his. Of course, it's not easy to read all the letters, but there is a book where all his wisdom is given with examples, the letters to shareholders. That also has helped me a lot. These are 2 books which have really been useful. And to learn or to understand the concept of cycles, capital cycles, one is Howard Marks, which is the most important thing. And the second one is Capital Returns by Ed Chancellor.
Got it. So we've got 6 book recommendations. To reiterate, the 4 on investing you are saying is The Art of Thinking Clearly. I have that book. I have not read it. I think I'll make it a point to read it next. Warren Buffett Letters to Shareholders Classics. Mastering the Market Cycle you mentioned.
The most important thing.
The important
first book.
Got it. So these 3 are the ones I would take away. And then you mentioned 2 books on advertising and
how to write.
And actually that's very true. I think what has happened is probably in this space, I see this so strongly that people who know they don't market it that enough, or I'll not say enough in the right way, because audience, it's about the audience at the end of the day. And probably people who don't know enough, they over market it in the wrong way.
Let me give an example of the need for communication quickly. We are likely to, very shortly launch a multi-asset allocation fund. And in the first attempt, our team came up with a 30-slide presentation. And I said, consumers don't have that much of time. Make it interesting. And one of our colleagues came with a very interesting story. And the story is as follows, that we use aluminum. Aluminum is perceived to be a very strong metal, but we use it as a foil for our food. And you can even crush the foil. I mean, that same aluminum, which is 99% aluminum and 1% some other material, if you add 8% of magnesium, zinc, and copper, the strength of that foil aluminum becomes so strong that you can make a plane out of it.
Wow.
Now, this is the way we introduce the concept of, adding low correlated asset classes. So by diversifying, you're increasing the strength of that particular item. Now, typically, we will talk about standard deviation and low volatility and low correlation. The common man will not understand. But if I explain through this concept that by diversifying and introducing in the right proportion, the proportion is also very important, you can create more strength to your portfolio. So that's the power of communicating with stories and real life examples versus just data from the market.
Very interesting. I think that was the last question, Kalpen. And with this, we come to an end of a very fascinating discussion, Mr. Kalpen. I think I'll put it this way that this covers few areas in a lot of details with a lot of filtered knowledge, which I feel more people should learn from. And it's been an absolute pleasure. I want to thank Kalpen for his time.
Thank you.
I hope you had a good time, and thank you guys for tuning in.
Thank you.
Please note, mutual fund investment subject to market risk. Read all scheme related documents carefully.